Alright, we're on part 3 of the presentation of chapter 8, and we left off on slide 49, so I'll continue here starting on slide 50 on managing receivables and the subject of extending credit. Remember, many companies are doing business with other companies, not just individual customers. This has an impact on how credit policy may be developed. For instance, an individual customer may be asked to provide employment and credit information before being extended credit, whereas another company, as a potential customer, may need to be checked out via a Dun & Bradstreet report of their finances and credit ratings, as was brought out in the text. The objective is to have a credit policy that balances the need to get new customers and expand sales to existing ones with the need to do business with reliable customers who have the ability to pay on their accounts. Going to slide 51 on establishing a payment period. Payment periods may vary depending on the type and amount of sale made, but there should be consistency for each type. As the text points out, there should be some consistency with what competitors are doing as well, so you don't establish too strict of periods compared to your competitors and therefore cost yourself some potential business. Slide 52 on monitoring collections. The aging schedule that was displayed earlier is a key tool in managing receivables because it breaks down the accounts receivable balance into aging groups that tell a lot about how successful collection efforts are and how liquid the accounts receivable balance really is and where the problem accounts may be. On slide 53, as noted on page 414 in the discussion of this example, note to the financial statements, this information is critical to external parties such as potential investors because it indicates a concentration of credit with a few large customers, meaning that there may be greater risk of a large default amount if one of these larger customers has financial difficulties and can't pay their bills. Moving to slide 54 on evaluating the liquidity of receivables. You should know how to compute the receivables turnover, that is the net credit sales for the year divided by average receivables balance, and the average collection period, which is 365 days divided by the receivables turnover factor. In the example above, McKesson Company had a lower receivables turnover in 2009 than 2008, and therefore also had a higher average collection period. So these two measurements move in concert with each other, but as one goes up, the other goes down, and vice versa. So note that its receivables turnover was lower than its nearest competitors, and in turn its average collection period was higher, meaning it was worse in both categories. Because it wasn't turning over its receivables as quickly, it also wasn't collecting them as quickly. So again, the lower receivables turnover results in a higher average collection period, and it's important to understand that relationship and remember that for quiz or exam purposes. Going to slide 55 on evaluating the liquidity of receivables. Note how the accounts receivable turnover is a measure of the liquidity of the receivables. That is, the higher the ratio, the better, because that means you're turning them over faster and you're getting cash in the door faster. The average collection period is a measure of collection effectiveness. The lower the period, again, the better. As the slide notes, if the average collection period is greater than the credit term period, then there's a real problem that needs to be looked at. On slide 56, on accelerating cash receipts. Receivables can be used as a cash management tool in several ways, such as tightening or loosening payment periods to get cash in the door faster, or perhaps ensure payments from customers who might not otherwise pay on time, if at all. But the most direct path to using receivables as a cash management tool is the idea of selling them to a third party who then needs to deal with collecting on them. The three main reasons for possibly doing this are cited on this slide. The size of the receivables balance. Companies may sell them because it's the only reasonable source of cash they have at the moment. And billing and collection are often time-consuming and costly, so they can offload some or maybe even all of that effort by getting rid of the headache and selling the receivables to someone else who then has that headache. You can see in the explanation in the text why retailers would be so quick to, I'm sorry, I jumped ahead here. Selling is also referred to as factoring, and perhaps the most common example is the typical credit card transaction at a retail store when a nationally recognized card such as MasterCard or Visa is used, as it points out in the text. And you can see in the explanation in the text why retailers would be so quick to accept credit card payments. For one thing, it takes the collection onus off of them and places it with the credit card issuer. For another, it enables the company to have its cash account credited at their bank, meaning a debit entry, of course, to their accounting records, as shown on page 418. The only drawback is that the card issuing bank charges a service fee for handling the credit card transactions in recognition of the responsibility of processing the transaction and then collecting on it. On slide 57, this slide notes the three parties involved in MasterCard or Visa card sales and the fee the issuer charges the retailer for handling the credit card transactions. Now on slide 58, this example is shown on page 418. Note that the amount of cash collected is less than the sales revenue credited due to the 3% service charge that the Visa card people charge them for that service. On slide 59, we're talking about the sales of receivables to a factor. That is a finance company or bank that buys the receivables from the retailer for a fee and then collects directly from the customers. In this case, a 2% fee is charged for taking on the receivables from the retailer, so the cash debited is less than the amount of receivables credited, kind of like in our credit card example, which reflects the service charge expense of 2% in this case. And on slide 60, see the response to the above question on page 444 of the text. The point is that factoring should not be an easy decision, nor should it be the first choice for obtaining cash. Some analysis, including the use of a cash budget to forecast cash needs, should be used in making the determination, since factoring will cost the company some fees that might exceed the cost of borrowing. The company needs to look at how it could streamline or even eliminate its collection activity if it went to factoring as a standard way of doing business. On slide 61, this chart shown on page 419 of the text shows the 5 basic principles for managing receivables that we've discussed in this chapter. Remember these for quiz and test purposes because it really points out how a very important account in most companies should be managed effectively and to get cash in the door as quickly as possible and to minimize the bad debts that may be experienced. And on slide 62, to wrap up, here's a brief description of how IFRS deals with receivables, which isn't very much different from US GAAP. Again, you won't be tested on IFRS, so this is just informational in nature. And with that, we wrap up the presentation of Chapter 8.